All right. All right, I think we're going live. There we are. Okay. Welcome everybody to Houston. We have a problem. My guest today, I've got Lucas Pinto. He's a real estate guru here in Seattle, and we're going to talk real estate. We'll just have a conversation and go wherever it goes. He is definitely bullish on real estate. I am, as you guys know, I'm definitely much more. The sky is going to fall, and we'll get our points across, and we'll have a discussion. And we may talk about stocks and crypto and anything else where we go. Lucas is can I call you a real estate influencer? Is that yeah? Okay. Excellent. Oh, wait, you know what? I don't know if you're coming through. One second, let me make sure your sound is working. Okay. Um, that's another problem I always have. Okay. Bam. That's working. Okay. Can you say something for me?
Can you hear me?
Oh,
Hello,
there we
hello.
go. All right. And now if you're so loud, you're blowing everyone's ears out. Okay. I'll turn you down there. Okay. Hopefully that's about right. I will keep my eye on that in case it goes into the danger red zone. So Lucas is here. He's a guy who really likes real estate, and to get everybody, like, I know a lot of you might be here for Bed Bath and Beyond talk. We may recap, talk a little bit about that at some point in the show, but I'll do a show tonight. I'll do an after dark show tonight, where we kind of talk about what's going on with Bed Bath and Beyond. So that's not going to be this show. It'll be tonight's show. After I get back from taking my rabbi roommate to a Sukkot thing. So, Lucas, welcome.
Thank you.
Yeah, so Scott, my former roommate, who's a video wizard, he put us
Yeah.
together and said you'd be a great guest for the show. And we were supposed to do a show last week, but my dad had to go to the emergency room and surgery and all that stuff. And so I had to postpone a week. So thanks for
Yeah.
being flexible on that. And he's doing well. He's up and about and happy as can be, and as if
Good.
nothing ever happened. So
Good.
yeah, yeah. Okay. So I watched some of your videos, and you obviously as a real estate agent, you want people to invest in real estate because, well, that helps you. But
Yep.
but what are your thoughts with the current market and where we're headed?
Yeah. So great question. So let me take a back step and kind of highlight real estate from a high level view,
Okay.
right? And I could send you some of these references and some of this data after a chart, or a lot of you guys could just Google it and you probably have access to this data. Real estate, residential real estate is an asset class that has gone down in value 3 out of the last 32 years. And out of those 3 out of 32 years, of course, were included the worst housing crash the United States has ever seen, right? Aside from that, it's an asset class that trends at an average historically of about 4 to 5% appreciation year over year. So I think in the current state of the market, and when we say real estate, anyone who says real estate as a whole needs to be very careful, especially now because real estate is hyper local. So I could give more reference and data onto our market. I can't necessarily speak confidently for the whole nation.
Yeah.
But I think for most markets,
And you're in Seattle.
nation,
I don't want to find out if we clarify that you're in Seattle. Yeah.
correct. I'm in Seattle. We invest in so I own real estate in Tennessee. We look into markets like Florida, Texas. So I'm familiar with other marketplaces as well. But my personal opinion of what's going on with real estate right now is if you look at a chart of what interest rates has done over the last 18 months, that was a very rapid increase in rates. Let's talk about residential, right?
Yeah.
We're talking about residential
Yeah.
real estate first, right? So interest rates went up extremely fast. Now, if you look at a chart of inventory nationwide, the amount of inventory for houses is lower than it was back in 05, 06, 07,
Yeah.
and lower than it has been in the last 20 plus years. There's a shortage of housing, right? So people are the demand is always going to be there because people need a roof over their head. The supply is at all-time low. And then the third factor that we have to look into is like, okay, let's see what new inventory is coming into market.
Yeah.
And there's also an issue there. Builders are not as incentivized to build because the cost of labor is way up, and the cost for them to borrow money is much higher than it was 2 years ago.
Yeah.
So what we're seeing is a bit of a bottleneck in the market. And I mean, here in Seattle, I have clients that are buying houses at an 8% interest rate.
It's crazy. I mean, it's like the 1980s. Yeah.
Your monthly payment is absurd, dude.
Yeah.
You know, I got a family that wants to buy a Marine, great guy, great family. They're retiring. They're looking to buy a $1.1 million house. This is their forever home. I'm on the call with him yesterday. He said, Lucas, my monthly payment is going to be $11,000.
Yeah.
He's like, I'm just an average guy,
Yeah.
you know? So the challenge with that is I don't see the problem, the foundation of the problem, which is more inventory. I don't see that issue being solved.
Yeah.
And I see Wall Street getting involved more than ever before in buying residential real estate, which for the past several years, Wall Street played in commercial. They didn't really get too involved in the residential space.
But BlackRock's bought up like a million homes across the US or something.
That is a fairly new concept, right?
Yeah.
Like these institutions getting into residential is something that started maybe in the last, since the crash, really, you know? So, and they're becoming bigger and bigger. They're buying more and more, you know? So it's, I think what's going to happen, and this is my, you know, this is my 2 cents. And I'm also backing this up with my own dollars. You know, I've bought 3 homes so far this year. I have a real estate fund that raises money from accredited investors, a 506c, and I'm going out and buying real estate with other people's money. That's a lot of responsibility, right?
Yeah.
But I truly believe, my thesis is this. I think that the federal government will have no choice but to lower rates and stimulate the economy within 12 to 24 months, because it's kind of the only trick they have in the bag, so to speak, right? And I think they're going to have to, I don't think rates are going to go down to where they were for mortgages. I don't think we're going to see the 2.5s, but there's still a lot of transactions taking place in our market. A lot of demand taking place, and rate, you're covering the cameras. and rates are at 8%. Imagine what will happen if rates come down to 6%. The amount of demand and buyer demand that will enter the marketplace, and I think that will naturally push up prices.
Yeah. So,
you know, my 2 cents, I think that by this time next year, we're going to be in a very different real estate market. I think there's going to be competition in most single family homes. I think there's going to be competition in most townhomes. I think for condos, that's a whole different beast. Condos are a little bit in trouble. But yeah, that might have been a lot, but that's my whole idea behind it.
Yeah. I mean, I agree with you. I think rates will come down. I think rates will come down largely because the economy has gone in the shitter.
Yeah, so, I agree with that.
And like we're raising rates now because we have to slow the economy down to keep inflation from happening, because, you know, you can't be paying as much for food and gas and living expenses and services as we have been at, you know, things, it's been growing at 8-9% for the last year and a half.
Right.
The big problems I'm seeing, and I think originally they'll stem from the commercial real estate market, is that, you know, the work from home aspect of COVID has made a lot of companies realize, like, oh, I can save $30,000 a month and not rent this floor of the office, and I can have all my employees work from home. So when my lease comes up, I'm not paying. And like right now we have about 1 in 5 commercial spaces are vacant across the country.
Yeah.
And it varies from market to market. Like San Francisco is like 35% vacant or something, right? But another 1 in 5 haven't paid their rent in a year. So looking at commercial real estate, where 40% of all commercial real estate across the U.S. is not generating income. We're seeing, these REITs, these big real estate investment trusts, where they have a $400 million skyscraper in Tampa, and they tell the bank, they're like, take it from us, we don't want it anymore. And the bank's like, we'll give you a 100-year bond. How does that work? And they're like, no, we really don't want it. And the bank's like, we don't want it. And so we're going to see like a lot of commercial real estate maybe become residential. That's what they're talking about doing in San Francisco. They've been doing it in like Calgary, Canada, trying to change a lot of this commercial real estate into condos and apartments and stuff.
They're converting a lot of these office spaces.
Yeah,
I agree with you 100%. Office space is at risk. That's a fact, and it's a bit of a bloodbath for commercial office space at the moment. Now, when people say real estate, we have to clarify, because there's a lot of little branches within real estate, and it could be a great opportunity for one specific branch and a horrible opportunity for another branch, like office space. Like, I know fund managers right now that are getting into office spaces, but they know what they're doing. And they're converting these office spaces into residential a lot of the time.
Yeah, they're getting them for a discount right now.
They're getting them at a major discount because, like you said, you have these debts. And just so folks understand, when you go to get a commercial debt, they give you it's not a 30-year fixed mortgage. It's usually a 5-year, 7-year with the balloon at the end. And these 7 or 10-year loans are coming due, and they're going to have to go from the 2.5% interest rate to 8% interest rate.
Yeah. And
that changes all of the returns on an investment, right?
Yeah, and they paid $400 million for this building, and it's worth $100 million.
Right, because the valuation, the way commercial is valued is so different than residential.
Yeah.
Right. Commercial is valued more like a business based off the net operating income. So when you have the debt that goes extremely high, your net operating income gets crushed, and the value of the asset goes down.
Yeah.
So office space is at risk, man. I agree with you. I think multifamily is the next one. We're ready. So for the fund, we focused on apartment buildings, so multifamily real estate. And we're starting to see signs in the multifamily space in some areas of things breaking down as well.
Yeah.
They're getting squeezed, they're getting, a lot, like you said, a lot of these apartment building owners got cheap debt. They don't know how to operate that correctly, or maybe they delegate it too much. Now that debt is coming due. So, but when I say real estate, what I picture of is your average consumer, mom and pop, got $10,000 in the bank. Should I go, buy some stocks, or should I buy a house? That's kind of, that's kind of what the avatar I have in mind when we talk real estate.
So like the big problem that brought down real estate in 07, 08. And I'd actually, I had a friend that she bought a condo in Paulsbo. It's a little town next to Bainbridge. In, I want to say it was like summer 2007. And she told me the price she paid for the condo. And it was like $350,000 or something for this 2-bedroom condo. And I was like, what are you doing? She said, so what do you mean? I'm like, that condo is going to be worth half of what it is like 2 years from now. It's like, oh, no, real estate goes up forever. It never crashes. I'm like, no, like this was the worst time to buy. And I had said this because I'd gone down to California. I'd visited my brother who lives in Orange County, or lived in Orange County. And one day we were down there, the cover of the Orange County Register had this giant headline that said, average home price in Orange County is $600,000. Woo! And they were like all stoked and everyone was celebrating. And I looked up and the average family income in Orange County was like $58,000. So I did the math in my head and it's like, no one can afford these houses here. This is unsustainable. This is coming down. And lo and behold, by about, November, December 07, you started seeing like, housing prices have gone down 1%. Housing stock is ballooned, blah, blah, blah. And as we saw, by the time we got into like well into 08, it was over that these things had gotten done. But my thesis for why it had gone down was different than why it actually had gone down, which was these adjustable rate mortgages. They basically took the limit off the adjustable rate mortgages, and speculators were buying like crazy. And not just speculators, but then families who should have gotten a long-term fixed rate mortgage, these brokers, these fly-by-night brokers, were talking them into these variable rate mortgages. And so like, hey, you can afford a $600,000 house, but we're going to put you in $1 million house at 1% interest for 2 years, and then you can refinance if you want. And they're like, okay, because I didn't know any better. And everything just, everything reset at once, because that's about 2006 is when they allowed all those adjustable rates, and it just went poof. And so we don't have the same level of adjustable rate mortgages today, thank God.
We don't. And homeowners in America have much more equity in their home than they've ever had.
Yeah.
I think we as a nation kind of got burned. My generation, for example, before I got into real estate, I was scared of real estate because I watched the 07-08 crash. I was growing up and I saw how nasty that was for everyone around me. And you're right. Back then, the mortgage industry was the wild, wild west.
Yeah.
I would go, it was borderline illegal. Like now that we look back at it, if I'm a mortgage person and I get my rate for 4% and I sell it to you at 8% back then, I get to keep the spread.
Exactly.
So I'm literally a salesperson incentivized to sell you the most expensive rate so I could make the most amount of money. It was just broken. It was a broken industry. And greed took over, and we saw the collapse that we saw. Yeah, I think in the environment today is very different than 07-08, and I think people today are like none of my clients, for example, we sell 130 houses a year. Yeah. All of my clients today, they're approved for $1 million and they're spending 900.
Yeah,
and all of our brokers advise them, hey, let's look at your monthly payment, because that's what matters, and let's make sure you stay in your lane.
Yeah.
That's there's ways, like anything else, right? Like if I think real estate is a good asset class, but you could still buy a good asset class at a bad time.
Yeah.
You could still buy a good asset class with poorly, right? Over leveraged or not thought out. I think anytime you do that, you risk getting burned.
Yeah, our neighbors to the north in Canada, they're about to have in January something like 700,000 or 800,000 adjustable rate mortgages reset from when they bought in December 2021 or 2022, and they got a mortgage rate at 2.5%. Now it's going to reset to 8 or more. They're trying to cap the interest rate in Canada, I think at 5, to try to keep this from exploding too much. But Australia has the same problem. Like in Australia, you don't get fixed rate mortgages. Like everything is adjustable rate, and they had a similar housing boom. My biggest concern right now for residential real estate is sort of the failure of Airbnb. Is that during COVID, when people could work from anywhere, Airbnbs were exploding like crazy because you didn't want to stay in a hotel, possibly get COVID. You want to go to these Airbnb houses where you could be with your little, your conclave of people who are in your group and everything. And you could work from anywhere in the world. So you're going to, a beach in Portugal and doing your Amazon job from there. But then, COVID starts to get over. They start bringing people back to offices or, not letting them travel for their work and stuff. And we saw a huge speculation where people were buying up homes like crazy during COVID to use as these vacation rentals. And there's too many.
Yeah.
That, you
Yeah.
know, and so what we're seeing right now is we're seeing in a lot of places, especially vacation areas, the average price of rentals starting to drop as these places
Yeah.
enter into long-term rentals because,
Yeah.
you know, they bought a house in, I don't know, Pigeon Forge, and they're expecting to make 5,000 a month as an Airbnb. Their mortgage is 3,000, and they're discovering they're vacant like 50% of the time. So now they have to
Yeah.
do a long-term rental, but the long-term rental, they can't rent it for 3,000 a month. They have to rent it for
Right.
2,200. Um,
Yeah.
and as more pop up, all of a sudden they have much more competition across this zone than they were expecting before. And
Yeah.
I think we'll see a first little burst of these short-term rentals becoming long-term rentals. And then as these homeowners, you know, they're getting bled $800, $1,000 a month on each one of these places over that course of time, we'll start to see them trying to enter the market again. But it will be
Yeah.
at the wrong time when, you know, mortgages, the interest rates are so high right now.
Yeah.
So I think I don't know exactly the time scale, if it's going to be in the next year when it will be, but I'm going to keep my eye on if vacation rentals start popping up for sale. And there might be short
Yeah.
sales, there might be emergency sales. I don't know. Uh,
Yeah.
and that's when I think that's the biggest detriment, I think, to the future of residential real estate is when those things all start popping up.
Yeah, that's a great point. I think that could be really relevant, like you said, in certain markets that are more vacation heavy markets. There's also a lot of regulation coming down on Airbnb, like for cities like Vegas and places like
Yeah.
that. Like these casinos and these hotels don't want Airbnb operating
Yeah.
and competing.
Yeah. New York just passed a law that you're not allowed to rent a single family home. Like it has to be the owner has to be present, and it could be a bedroom or
Yeah.
something. And
Yeah.
almost immediately, like you can go on Zillow and you can see in Manhattan, you know, 2-bedroom condos selling for under $300,000 all of a sudden. Like
Yeah.
that hasn't happened for 15 years.
Right. Right.
So
Yeah.
yeah, so speculators, some of them are screwed.
No, I think anyone who is speculating is
Yeah,
exposing themselves to more risk in the first
yeah,
place. You know what I mean? Like, so I agree with you. I think some markets will be impacted by it. As far as we have seen, when we saw rates start going up as rapid as they did, the speculation around the real estate industry and everyone outside the news and everyone
yeah.
else was, well, we're going to start seeing foreclosures and short sales all over again. And we didn't. You know, like you look at the number of short sales and foreclosures going on in residential real estate, it's like it's irrelevant. There's
Yeah.
really
Well, I mean, some people locked in, you know, in 2021, 2022 at such low rates. That's why we've got such low volume
exactly
because they're like,
exactly.
I'm not going to sell now. I'm at 2%. I'm good.
Why would, for example,
Yeah,
I have this house.
yeah,
I don't want to live here anymore.
yeah,
I'm not going to sell it. I have a 2.5% interest rate.
yeah,
My monthly payment is $3,000 a month.
yeah.
It's a 3,200 square foot house. If I go to rent a 1 bedroom, I'm
Yep.
going to be paying that, you
Yeah.
know? So it's like, and that's the majority of consumers because they locked in such an attractive rate. I'm a big fan of real estate for this, you know, and I'm a very conservative person, dude. Like when it comes to my money, like I want to make money for sure. I
Yeah.
don't care if it takes a while.
Yeah.
You know, that's always been my approach. So I think for your average American, and the federal government came out with the stat, the net worth of your average American that owns a home compared to an American that rents a home, the homeowner had their net worth is 40 times that of a renter.
Yeah.
So if someone in a consumer that's considering buying, they got to be reasonable and understand that no one's going to care about their money like they are. So ask yourself, okay, what's my time frame for being in this house?
Yeah.
Am I going to be here for a while? Can I afford the monthly payment? Someone who buys real estate and sits on it for 10 years, it's going to be very hard for you to lose money. And it's going to be very hard for you to get less than a 5% return on your money year over year.
Yeah.
Oh, so that's kind of the way I see it. Now, you know, within real estate, you could start, there's layers of complexity. Now you're
Yeah.
talking about a second or third home in a market that you don't understand. And it's like, okay, there's an additional layer of risk there.
Yeah.
Are you prepared and competent enough for that?
Yeah.
So I think people start getting like, it's the same thing for stocks, right? Like I have a basic understanding of stocks. I'm not going to go and take 50,000 and play options because I don't know it like you do. You know what I mean? It's people have to understand their lane and stay within it. You know?
So on your side, are you seeing it? Like, is it still a seller's market in Seattle?
It is. So the way we track that is by months of inventory.
Mm-hmm.
So if a market has around 5 to 6 months of inventory, that means that's a neutral market. Neither buyers or sellers have an advantage. King County at the moment for single family homes and townhomes, we are averaging about 7 to 9 weeks of inventory. So we're talking about 2 months worth of inventory. So it's still technically a seller's market. So to give you context, in 2021, we had about 1 week worth of inventory. There was absolutely no houses on the market. The number of houses on the market now is technically lower, but there's also less demand in the marketplace to buy.
Yeah.
Because
of those interest rates.
Because of the interest rates. Exactly right. So there's less inventory, but also less demand than there were 2 years ago.
Yeah.
I've been selling real estate here for 8 years. And in the last year was the first time in 8 years where if you're a buyer, you could do an inspection.
Yeah.
You could think about it overnight.
Yeah.
You could maybe get a little bit of discount on price.
Yeah. My buddy Jed is a home inspector, and like he's done well for himself, but like all of a sudden he has to turn people away. He didn't have to do that for the past few years. And because the home sits on the market for now a month. And you might not be getting the cash offers you're getting before. So someone's like, hey, I'm gonna have this guy inspect this home and let me know if like there's rot everywhere or a leak in the basement or whatever, which so much was done sight unseen. It's pretty crazy.
Yeah. But what's interesting about real estate is I've watched this closely. Real estate, there's a huge component in real estate that is consumer sentiment. And it's almost an energy around the market that if you're in real estate selling houses every day, you start to feel this energy pick up and catch fire pretty quick. And I experienced it during COVID. When COVID hit, there was so much fear for about a month where all of my sellers they wanted to do price reductions. Everyone was scared. And that was just simply the sentiment around the industry. And what did we see for the next 6 months? We saw the fastest. It was madness. It was in a course of 3 months. And for example, I owned a townhome in Sammamish, and I was considering selling it. I believe it was $460.
Yeah.
I was like, I'm gonna rent it out for a year. I rented it out for 1 year. 1 year later, I sold the same townhome for $575.
Yeah.
That price increase was just consumer sentiment and hype.
Yeah.
So I think we're going to see that at some point next year, in this area. I can't speak for all national markets, but I really think we're going to be seeing that in King, Snohomish, and Pierce County. For single family homes, condos are a different beast. And I'm making bets behind it. Now the bets that I'm making are also, I'm hedging my bets, meaning, okay, if I'm wrong and I have to rent this place out, will I cash flow? Can I plug in a tenant that will cover my mortgage?
Yeah.
So it's, for me, worst case scenario, I have an asset that someone's paying for. So there are ways to navigate it depending on your the amount of capital you have to play with and your risk tolerance and expertise.
Yeah.
So.
Like a lot of the homes, my real estate friends here on the island, I'm always asking like, what's going on? Like, tell me like, what's happening. And it's still cash sales here on the island. It's a lot of, Yeah, a lot of rich people, they have a whole bunch of stock holdings or something. They take out margin on that and they just buy their home with cash.
Yeah.
And I'm always flabbergasted because the homes are selling for like $2-3 million. I'm like, holy shit!
Right.
You get that much cash together, amazing.
It's but on that note,
Yeah,
it's also, it's tough because it's a bit of a catch-22 for consumers
yeah,
because I have a lot of rentals. And over the last year, we increased our rents on average by about 9%
hmm,
across the board for all our rentals. The national average rent increase for the last few years has been 8%.
yeah,
So it's like your average consumer is getting squeezed every way.
yeah,
It's expensive to buy. You're also getting squeezed if you rent, and you got to pay to live somewhere. You know what I mean? So
yep,
it's like I think when you put those two choices side by side, I believe everyone in this country, or not everyone, but the bulk of consumers should look for a way to get into a home
yeah,
conservatively within their budget. You could get creative if you want, meaning you maybe buy with a roommate or two other people in order to make it affordable. But I think that's just, I think it's a wise move, you know. Um, yeah. So, I mean, we'll see. Time will tell, right?
yeah. Have you read much about what's happening with Chinese real estate and
I
going on
I
there?
I did read what's just things flashing on the news,
Yeah,
right? It seems like they're in a bit of trouble. It seems like they're going through the 0708 that we went through here.
I think they're going through that on steroids. Like,
Yeah.
China, they had blossomed. They were doing lots of crypto. They were mining lots of stuff. Then China put a kibosh on it, so you couldn't do crypto anymore.
Mhm.
And they also have a problem for the decades they had their one-child policy. They created an imbalance between men and women in the population. So now there's way more men than there are women, and these young men can't find brides. And
Mhm.
so they had to go out and they had to find real estate they could purchase, so they could tell a potential mate, like, hey, I'm a landowner. I've got a condo. I've got this. I've got that. And it would lift them up socially in the eyes of potential mates.
Mhm.
So this market came about that's sort of like Bitcoin, but with real estate, where these real estate companies will go out into the jungle and build 1 million units of what they call tofu dang construction, which is this like crappy, it's not actually a house. There's no stairwells, there's no windows. It's a giant tower, and they sell units of homes inside these things for some exorbitant amount of money. And then the young man buys it sight unseen because he's never planning on living there. It's 100 miles away from where he actually lives and works. And he can go to his potential and be like, hey, I own a house. And her parents go, excellent, he owns a home. You can marry this young man. And then he sells that home to the next guy who buys it for,
Mhm.
for more, right?
Right.
And what seems to have happened is they built too many of these homes and they ran out of young men to sell them to. And
Wow.
so all of a sudden, all the tofu dan construction stopped because no one was buying those anymore. And then whoever's last holding that baked potato, the hot potato, they're stuck with it. And on top of that, they had a whole bunch of I call it pay as you go construction. I don't know how to phrase it, where they don't really have mortgages in China. You basically talk to your aunts and uncles and you get loans from them, or they invest and you help buy a home. And you would
Mhm.
pay a real estate company like, hey, I'm going to give you $150,000 now. And a year from now, when this construction is done, I'll have my condo. And the real estate company's like, perfect. Um, it turns out that they were using a lot of that money to build these speculative tofu dang construction for all these unwed young men,
Yeah.
and they weren't getting the returns on it anymore, so they didn't have the money to build the actual homes for people. And
Oh.
so now you have millions of people across China who spent their entire life savings, their grandmother's life savings, their aunt and uncle's life savings, all to get this one apartment in Shanghai or Fujian or wherever they are, and it can't get built because the real estate company ran out of money. And
That is wild.
yeah, so China, 1/3 of Chinese economy traditionally has been real estate, and it's halved in the last year and a half. And
Wow.
on top of that, numbers just came out that there's 3 billion housing units for 1.4 billion people in China. So
That's insane.
All speculation. And because, you know,
Yeah,
this stuff
by
gets
law.
approved by the local Chinese government. Like, hey, build 1 million units. And the company just goes out there and builds 1 million units. Well, they don't have 1 million people for them. And so it's just these giant ghost cities everywhere. So this coming around to the potential of what's going to happen in the future, this Chinese real estate, on top of their huge, beautiful, amazing civil infrastructure projects, you've probably seen about this high-speed rails and the, you know, canals and the other train and public transportation systems. So they spent, you know, trillions of dollars on this. In China, it's illegal. It's illegal for a municipal government to float a bond. So you can't be like, hey, we need to build a new train station. Let's float a bond to do this. The federal government, the Chinese, the CCP is like, you can't do that. But for the last 20 years has been looking the other way while municipalities across the country build high-speed rail and infrastructure and, you know, gymnasiums and everything else. Here's the crazy part, is that it's you and me who paid for it, not the Chinese government, not the Chinese people. They floated bonds in international markets. And so, you know, BlackRock, Wells Fargo, Union Bank of California, Royal Bank of Canada, HSBC, they're the ones who bought up all of those bonds with our deposits. And now they're defaulting on everything. So like Royal Bank of Canada has $14 billion in these commercial bonds for Evergrande, which was like one of the largest of these Chinese companies. Mm-hmm. They still haven't written them off as a loss because they're just hoping against hope that somehow this company that's $300 billion in debt and has no income will somehow pay them back. Right?
Mind-boggling. That is mind-boggling.
Yeah. And on a smaller scale here in the US, so SVB, the Silicon Valley Bank that went under back in March, and it kind of brought down some other regional banks. Yeah. They had, you know, they did the responsible thing. You deposit their money, they lend it out, and, you know, they get the interest rate and so on. Well, a lot of the bonds that they owned were these fixed rate bonds. They're now, you know, 1-2%, whatever. And all the new bonds were at the time 5-6%. So the stuff that at 1-2% became worthless. And there's a run on the bank, which caused them to have to sell these worthless bonds at a huge loss, which caused everyone else to freak out because, oh my God, they don't have my money anymore. And they ran on the bank. And I'm very curious to see what these large institutions, our shadow banks, commercial real estate banks, investment banks, what the fallout's going to be when they have to write off trillions of dollars in these Chinese bonds for the depositors.
That's a great question. And I'm not smart enough to answer that.
Yeah.
But I went to a fund manager meetup. So I'm part of this group called the Black Card. Mm-hmm. And this group is for aspiring new fund managers or more established fund managers. The average fund size in the room is like 100 million. Yeah. Guys that are smarter than me. And one of the gentlemen that would kind of, he's actually the father of Bridger, who's the guy who put this event together. Yeah. And he was a fund manager, Bridger Pennington Sr. is his name. And his fund was Bridge Fund. They IPO'd in like 2020 for like billions and billions of dollars. And he had a very interesting take on what he thinks on a macro level is going to happen over the next few years. Yeah. This is someone who's a billionaire, right? And he's just kind of spitballing, throwing out ideas. And I kind of agree with this. I think there is, as you know, over time, currencies, their natural life cycle is to fail. Yeah. Right? Currencies fail over a long enough time frame. He believes what's going to happen in the US is similar to when we got off the gold standard. It was just kind of this thing where turn in all your gold. We're going to be using these dollars now. He thinks the same thing is going to happen digitally. A form of economic reset per se. Yeah. He thinks currency, as we know, is going to be a digital USDC coin that you do everything virtually, right? In order to kind of reset the system and give us more of a lifeline, because we're spending a lot more than we're able to produce. And
Mm.
that at some point, the cows have to come home, so to
Yeah.
speak, right? And I think it will happen within our lifetime. I feel like it has to, you know. How do you brace for that? Who knows? For a while there, you're talking about China. For a while there, I read Ray Dalio's book, Changing World Order.
Yeah.
For a while there, I was intimidated that maybe China had a chance of taking over the U.S. as economic world power.
Yeah.
I don't feel as confident in that anymore, but I felt like at a point that was a real threat.
Yeah, I mean, in the 1980s, we were terrified of the Japanese buying up all of our real estate, right? And then they completely stagnated, largely because their population started to shrink. And May of this year was peak Chinese population. They're from now on shrinking. In the next 30 years, it's supposed to go from 1.4 billion to 600 million people. And what has like made the Chinese engine so powerful is, you know, the central government's ability to be like, we need 600,000 people for this factory tomorrow, and 600,000 people show up. And, you know, on my show the other day, we're talking about the size of the Foxconn factory in Shanghai. And yeah, it's 600,000 people working in one phone factory. You cannot get those numbers anywhere else on Earth. Yeah. And like that's the population of Seattle working in one factory. Right. So yeah. And so if your population is going to more than halve over the next 30 years, who's going to be working in those factories? Like you just want you have to automate everything, but that's really expensive, you know?
Yeah.
And that's one of the problems Japan was running into. So I went to school at the University of Hawaii at Hilo on the Big Island. And and the my favorite resort that we called Big Island Disneyland is the Hilton Waikoloa. And Hilton Waikoloa was built in the 80s at the cost of like $200 million by a big Japanese investment firm. And then the Japanese economy collapsed and they had to sell that building for $60 million to, I think Hilton has ended up buying it. And I don't know who's the main investors behind it now. But I think, you know, we have all these big Chinese investments happening all over the world with their Belt and Road system. And they're at a big disadvantage with the system because they're kind of doing what the U.S. government did for a long time when we had our own economic hitman. Like we would go to Brazil would be having economic trouble. Like, okay, we'll fund the IMF and the World Bank to bail you out. And you need to be upgraded. So we'll help you pay for this giant dam to make some energy, but the dam's gonna be built by an American company and then you're gonna owe us billions of dollars for it. So cool. And then we just like wreak havoc around the world. We do it in, you know, Kenya and in Indonesia and Cambodia, wherever. And now the Chinese are doing that. They're like, hey, you guys need a highway? We'll build you the highway, but you have to use a Chinese company to do it. And then you owe us all this money for the cost of it, or build you a port or an airport. But the people they're paying in China, not in Chinese yuan, they're paying in US dollars because the Chinese government doesn't want the yuan as a global currency. They bluster and act like they do, but they don't because all the billionaires in China will leave because they saw that happen in Russia. Once they saw they could get out, they got out. And, you know, so they've got limits. They got limits like you can, you know, what would be the term, expatriate your money, like 50,000 US dollars equivalent per year. So that means these Chinese guys can't necessarily like dump their funds into a Swiss bank account and bail because they'll hit their limits really easily. So you got China they're shrinking in population. They are making it difficult for their currency to be used globally. Like I don't see them as sort of the giant financial threat we originally thought they were going to be. Largely because of that. Like US government, say what you will about our economics or whatever, our number one export is dollars. We export that stuff everywhere. And we sell
it like hotcakes.
Exactly. You need some dollars? We'll print some more and send them to you. And then you can buy whatever you want because it's a hard currency. And that I think is our biggest benefit is like, maybe we shouldn't print so much inside the US, but we can print and send it to other nations, right? And they can buy our stuff that way. I don't really know where I'm going with this. I kind of lost my train of thought there.
I have a question for you,
Yeah.
Houston. I mean, I'm shocked by chatting with you. I asked before the call started. I'm shocked you're not involved in crypto. You know what I mean? Just based off the points you're making, I would think for sure you're a Bitcoin guy. You know what I mean? You have a really good understanding of.
I have dabbled in the past and speculated in the past. But so, and my viewers know this, the biggest problem with crypto, I guess there's two halves to the biggest problems with crypto. One is what crypto is used for. Right now, there's three uses for crypto. There's paying for crimes, there's money laundering, and then there's speculation. Yeah. But due to things like gas fees, adoption, things like that, like I can't go to the grocery store and buy a stick of gum using Ethereum. Like they could set up a payment process for it, but the problem is that the gas fees involved. To buy a 25-cent stick of gum is going to cost me $70 in gas fees. So it doesn't. That's not useful. I mean, they can change that in the future. We can wait on that. But until it's like regulated and we stop having every exchange blow up because they're stealing everyone's money. You know, the main market's going to be money laundering and paying for crimes. Like if I'm a drug dealer and I need to move $100 million from Venezuela to a bank account in Switzerland, you know, Monero is a great way to do that. So fantastic. I need to pay for a hitman to knock off my old lady, you know, Bitcoin, probably not Bitcoin because they can trace it pretty easily now, but you know, bounce it through a few wallets and then get to your hitman. But like until it can actually be used as a currency, you're going to run into problems with and it's so volatile. Like, we all know the story about the guy who spent 11,000 Bitcoin to buy a Domino's pizza back in like 2008, right? He's probably blowing his brains out. You know, you don't want to like do this deal with crypto and then find out they either got screwed or the other guy got screwed, because it keeps people hesitant from using that. So there's a coin XRP. There's this coin that's used for like bank to bank transfers a lot, and everyone keeps saying like, oh, it's going to be huge. Like it's not, because the banks don't want volatility in it. They don't want to like transfer from Wells Fargo to JP Morgan Chase and find out that one of them, you know, lost out on $8 million or something. So they want to keep it as steady as they possibly can, which is good for a currency, but bad for speculation, which, you know, should keep investors kind of out of that. But the other side of what's bad is US dollar tether coin. I don't know if you've ever read about US dollar tether coin, but they stole everyone's money. It's gone. About $80 billion were spent on US dollar tether coin. People would want to join an exchange to buy crypto, so they would send their money to US dollar tether coin. They'd get a 1-for-1 of their coin, of their cash for coin, and they go buy Bitcoin or Ethereum or anything like that. There was a period of time where 80% of all Bitcoin transactions were done using US dollar tether coin. So that means if you wanted to get your cash out of Bitcoin, you sell it for US dollar tether coin, you exchange US dollar tether coin, get your cash back, everything's good. And what they had told everyone was, we're just going to take your cash, put it into an account, it's going to gain interest, that's how we make our money, and then whenever you want it, you can pull it out. Well, in May of 2021, regulators went looking for that money, and it was gone. At that time, it was about $69 billion was gone. They had about 3 cents on the dollar left. So if there's ever a run at all on Tethercoin, it's going to crash the entire cryptosphere and depeg and go crazy. So, you know, I'm just wondering, like, when people want their money, like, at this point, yes, crypto has its value. It's not a fiat currency, blah, blah, blah. But it's still valued according to the US dollar, right? Like, you judge how much your Bitcoin is worth by looking at its price in US dollars. You don't look at it in price compared to Ethereum or whatever. You're just like, oh, you know, it's $27,000 today. So if you have all these cryptocurrencies and all of them are using the dollar as their unit of measurement, that just means the dollar is still really strong. And, you know, on top of Tethercoin, like stealing everyone's money, they also minted whatever they wanted. They just I'll produce $1 billion, and then I'll go buy $1 billion in Bitcoin off an exchange with that. It was never backed by anything. It just arbitrarily was pegged at 1-to-1. And so a lot of the buying pressure that was happening that drove Bitcoin to like $60,000 a coin was fake Tether coins being minted and used to purchase that. Uh, so as far as crypto goes, like I'm not touching it until Tether finally implodes, and then I'll go pick up the pieces. So that's where I am at. I mean, and Binance is going down, FTX blew up, Luna's gone, like, and all of them were crime. Yeah, all of them are crimes.
Yeah, I agree. There is a lot of scams, and the crypto community has been pushing for regulation.
Yep.
It's just slow, right? Now, let me ask you a follow-up question. Do you think once regulation comes out and institutional investors get involved, do you think you will get involved? And do you like the concept behind what money like Bitcoin could serve?
I think first, large institutions and hedge funds will get involved, probably to capitalize on the crimes. I think because they love committing crimes just as much as anybody else, as long as they can get away with it. And they did it in 2008. They did it the savings loan crisis. They did it during the Great Depression. Like if there's a loophole and they get away with it, they will gladly be involved. And then when everything collapses, they go, "Oh man, Ted and speculative crypto, he really screwed us on that one, didn't he? Oh well,
On to the next one."
Yeah, exactly. So, I don't know. Like, I see like you got a Bitcoin, right? And you have Bitcoin. Its value is based upon how much the next guy is willing to pay you for it, right? There's no other. You're not getting dividends on it. You're not. Yeah, like I buy a piece of stock that's fairly rare, right? Everyone's like, "Oh, there's only gonna be 21 million Bitcoin ever." Okay, there's 14 million shares of costs. There's only gonna be 14 million shares of costs pretty much ever. Why is cost, which can pay you a dividend potentially at some point, worth $8 a share, and this Bitcoin, which will never pay you anything, is worth 27,000. So, it's not much different than the NFTs and how those crashed really hard. One of the things when I went super viral and I became like an internet personality, I coined the phrase NFTs are just beanie babies for tech bros. And people were like, "Huh, you know what? Yeah, I guess buying a monkey picture for $250,000 probably isn't the best investment I could do with my money." Right? So
Bored apes were getting out of control.
Yeah. And now they're not worth anything. 2 years later, just poof, gone. Just like beanie babies.
Has the values for Bored Apes gone down?
Oh, they're worth nothing. I bet a Bored Ape that sold for $10 million in 2022, you could buy for $10.
You're kidding.
No.
Really?
Yeah, they're worthless now.
That is wild.
So like that is like, the classic tulip graph. It just went and then boom, right back down again. So I'm waiting on crypto. I'm sure, the CBDC, the central bank digital currencies that are being tested right now, I'm sure they're going to be used by everyone at some point, not just bank to bank transfers between the Federal Reserves and stuff. I don't think cash is going to go away for the US, because cash is so important for our currency, because it's not just Americans who use our currency. It's people in, the Ivory Coast, in Zambia, in Venezuela. And if you don't have electricity, you don't have internet, a digital currency doesn't do you any good. You still need this flow of paper capital going around, because, a third of the planet, 4 billion people or so don't have access to electricity or the internet. And so if you go, okay, we're getting rid of cash and you're gonna have a chip in your arm and you're just gonna boop and pay for things that way, it does no good for a good portion of the population around the planet. So, and we want them to have dollars. We want them to want dollars. You want to be able to go as an American, head into, I don't know, like Lagos, Nigeria, and be able to eat like a king on $1 right? So like that is really good. They won't be able to, they can't take a credit card. They don't have a credit card machine. So I don't think we're going for full replacement of digital currency yet, simply based upon the inequities across the globe and the importance of the US dollar being sort of a goal of so many of these nations to possess. In the US, we'll probably see more digital transactions anyway, because we're a first world nation and everyone has phones that they can boop at the register and stuff. So we're definitely we're in the early days. We're in the Wild West.
100%. I agree with you on that. Let me ask you where if you were to place your bets for a more, let's say your portfolio, for example, how is your portfolio divided up at the current moment? You know, what asset classes are you 100% in stocks? How much do you hold in cash? I'm always interested to hear.
Basically, I divide it up between my long-term, I don't even look at it, investments. Those are dividend stocks, index funds, things like that. That's just stuff that you just put your money in it, you forget about it, it grows year over year. You know, if there's a correction in the next couple of years, it'll take a hit, but it'll bounce right back. And then I have sort of my investments that are companies I think are companies of the future, like startups, stuff that are providing tech or are entering growth industries that will boom. So they're definitely speculative. I dump a bunch of money into those thinking, okay, if it goes in this market, this company could be worth $100 billion, which means every single one of these shares I have could be $500 to $1,000 each when they finally realize their goal. So that's I could be a billionaire off of this. And then I have my gambling, my degenerate gambling plays, which we talk about a lot in my show. Which currently, like the big one that we're hoping to explode is Bed Bath & Beyond, which we were talking about before we got on. That if indeed this is a merger where the shareholders maintain equity, the thing's going to squeeze. And that this is not an investment like, oh, I think this future of Butterfly that they're becoming, it's gonna be a real solid company 20 years from now. Like, no, I'm going to get out when they pay me so much money. I go, all right, fine, I'll give up and I will settle with my cajillions, right? I might buy back in when the price collapses again, but anyone who buys a stock at 27 cents and it flies to thousands of dollars a share and then drops to $15 and never touched it, you're a moron. Sell at $1,000 a share, buy back at 15, you're good to go. So that's sort of my three areas. Oh, and then I also have what I use my Schwab account for, which is because they're like an absent drunk stepfather. You can do whatever you want in that account. They don't really care. I play lots of like defunct penny stocks with that. And you can go in, you can buy $500 of some company that may have been bankrupt a long time ago or produced 8 billion shares. So their stock is like at 1/1000th of a dollar, 1/10,000th of a dollar. But it goes 1/10,000th of a dollar, and all day long it bounces to 2/10,000th of a dollar. So you can double your money pretty much whenever you want. And so I play those a lot. And every once in a while I play that, and then it just pegs at 1/10,000th of a dollar, never leaves that point. And I go, oh well, I'm never getting that money back. So those are like where I play. That's my diversification. I do lots of like, if I think the market's going to shit the bed, I'll invest into like inverse ETFs that spike when that happens. So we'll do that. This week would have been a good week to do it.
Are you in any AI stocks?
Not at the moment, no. I'm sure those will explode and be huge. But I don't know. Like, I think there is regulation coming for AI, and I don't know. I don't know if it's going to be used in a way that makes people money. Does that make sense? Mm-hmm. Like, a lot of what's been used is the same thing as monkey pictures, right? You go, I'm going to tell it to like, I want to make John Oliver as Superman, and then it pops up. But it's not being used on a large enough scale for like data analysis as it probably should. It will be eventually. You'll have AI and everyone's like healthcare records looking for, diseases here and there and analyzing DNA and whatnot. But the problem is that it becomes a black box, and even the developers don't know what's going on inside of it. And you get a lot of the AI. You tell the AI, like, hey, can you write me a paper on this scientific, fact or whatever? And it makes it up because it doesn't know it's supposed to go get you all the facts. It's like, well, it wants me to write this paper, so I'll do whatever I can to get this paper done. And it just makes it all up. Just like it makes up, John Oliver looking like Superman. That's what you wanted, so I made him look like Superman. That's not a fact. It's just what I did. So as a teacher, I see now most of my colleagues, because I teach science classes and they have papers in there. Some of their test answers can be that way, but I'm seeing just it's so easy to spot these Chat GPT papers because the facts are all wrong. They just make it up. They'll make up entire like bibliographies of authors and books that never existed. So you're like, oh, this paper looks great. It's got an entire bibliography. It cites all its sources. Turn it in. And that's all fake. So I'm very curious to see if like you have these search apparatus AIs, you have an AI for the Department of Defense analyzing threats. Like all of a sudden, is that AI analyzing a threat that Palantir or some defense contract is doing? Is like, you have to watch out. The orcs are assembling in Mordor. Like, no, they're not. Why are you telling me this? Like, because they're making it up, right? So, they'll definitely be huge. They'll definitely be gigantic. I just don't know how, when, why they're actually going to make decent money off of it until it happens. So, I'll invest in ancillary things like the Steadfast, the Googles, the Microsofts, the Apples that are dealing with it, but not the companies themselves, because I'm sure they'll all get gobbled up in the end anyway.
Yeah, I picked up quite a bit of Microsoft before they I think they threw $1 billion on Chat GPTs.
Yeah, now they're using it in Bing. Yeah.
Oh, really? I didn't know that. So that's crazy, man. But I got about 5 minutes here, Houston, and I got to get going.
No problem.
It was. I love chatting with you, dude.
Yeah.
You're a really bright guy. I could sit here for a few hours and just shoot the shit with you.
Well, we can do like every few months do an update, talk about trends in real estate and where things are going, and
that would be super cool. Yeah, it would be cool to see, kind of backtrack last episode and see if I was right, if I was wrong. Like I have no problem being corrected and admitting.
No, I'm wrong constantly. Like sometimes I hit a giant home run and everyone's like, "Whoa, got a crystal ball." And other times I just flat wrong. And you have to admit it when you're wrong. Like, I was wrong about that. I totally missed the mark.
I think that's the interesting thing about being an investor over a long enough time frame. You start to notice your tendencies and also your mistakes along the road, which makes you a better investor, regardless of the asset class, in a long enough time frame.
Yeah.
Right. So I love the process of it. I'm intrigued by it. I'm intrigued by real estate as an asset class, by crypto as an asset class.
My biggest strength, I think, as an investor is the one thing I can predict are assholes. Like, I know how an asshole works. They're so predictable. They're just if you got a choice between two things, they're gonna pick the asshole thing, and that's where they're gonna go. So as long as you know that that's their mentality, you just follow that trait into whatever end it is, and that makes it really easy to like pretend like you've got a crystal ball. But if you can't tell if someone's a true asshole or not, then it becomes really hard to figure out which way they're going to go on a decision.
So is that kind of what got you into GameStop when you did? Is you kind of you picked up this? Yeah,
it's like hedge funds are full of assholes. They're really predictable. So. They all do the exact same thing. They all make the same exact plays. You invest in one hedge fund, you may as well invest in the other hedge fund because they have the exact same portfolio, the exact same stocks they've shorted. They're the same. So, that's because they're the same type of dudes. So, Chad Chetfield III, I got a corner office after I graduated business school because my dad's the president or whatever. And they just do the same stuff over and over because they all learned from the same people 30 years ago about how to do short hedge funding, and they all form their own hedge funds. They just do the same thing. So If Apollo is short on GameStop, then Citadel's short on GameStop, right? And so is 0.72. So is Melvin. So they're the same people, just cloned over and over again.
That's too funny. This group that I was referring to, a group of fund managers, it's called Black Card. The whole theme of the group is Wall Street rebels, because they want to. This group of fund managers believe a lot more that you could get better alternative investors or better returns on alternative investments for smaller funds instead of going into major hedge funds and going with those guys. That's the whole idea behind it.
Yeah.
But I love it, man. It was really great chatting with you. Thank you so much for having me on. And if there's anything I could do to help you out in any way, shape, or form, or any of your listeners, I'm an open book with everything. I'm happy to help. So yeah, man, it was really great chatting with you.
It was a pleasure. Thank you so much. And I know the chat's been like yakking like crazy, but you got to go, so we aren't gonna have a chance to like go to their questions.
Wait, I got a good 2 minutes.
You got 2 minutes? Okay, let me scroll through here and see. All right, it's all Bed Bath and Beyond, Bed Bath and Beyond, Bed Bath and Beyond.
That's funny.
People saying, reminder that Houston has a guest, he'll concentrate 95% of his time on the guest and not the chat. AMC, okay. People asking me to transfer there. SEC and Finner questions. What's we have a question for the guests in here? Everyone's just having their own conversations, it looks like.
That's too funny.
Oh, here's a super chat. Anyone want to learn about the upcoming housing market crash? Read up on DSCR loans like Airbnb loans. Okay, that's from JJ. So I guess look up on DSCR loans, aka Airbnb loans. DSR. Where's my pen? There's my pen.
Oh, debt service coverage ratio loans.
Debt service coverage ratio loans.
Yeah, I've sold over 500 houses.
Yeah,
I have to do a debt service coverage ratio loan. They're so rare.
Yeah.
But yeah, I guess that I don't have enough knowledge on it to give an honest opinion. I just know they're super rare. They're not as common.
Well, I take it you're not selling. You're doing mostly families looking for a home, right? Not speculators looking to Airbnb.
We're doing mainly residential. We've sold Airbnbs. We do a lot of first time investors. Yep. So for someone who's looking to buy their first rental, but we're super conservative. Like we're not going into. If you look at the data that we use, like we know the appreciation for that zip code for the last 10 years. Yeah. We know what the rent is for that house. Like we're not you know what I mean? Like nowadays you're going into an investment with a really good understanding of what you're going to get. Yeah. But in other markets, I think it might be different, like more Airbnb friendly markets.
Yeah. I'm thinking like, you got your Branson, Missouri, Pigeon Forge, Daytona, like stuff like that. Their market's going to be way different than places where people live.
Yeah.
So,
I agree.
Yeah. Oh, cool. Thank you very much, everybody. Thank Lucas for joining us today and covering the world of everything. All right.
It was great chatting with you, man. Take care.
All right. Have a great night. Okay. Oh, I disappeared. Host ended the meeting. I guess I've gone black because he was the hosting that meeting. So, hello. Hi, everybody. We're going to be coming back and doing an evening show, like a regular show. We'll talk all the questions you've had here. We'll start answering them for that. So that'll be a nighttime show whenever we get back from the Sukkot. So I don't know how long that'll last. Maybe after 8 p.m. Pacific. So in like 5-6 hours or so. We will see you then and see how much how much rock and roll we got in there. I've not seen any documents drop that were very big today. There was a document that dropped yesterday about paying legal fees on former board members who are facing a lawsuit. And in that, there is language about a targeted acquisition. Now, I don't know if it's boilerplate language that goes into a document like that, but the fact it's in there makes everyone go, target acquisition? That's interesting. So, yeah. Yeah, so, yeah, got anything else, Monkey? No, that's it? She's cool. I'm cool. You're cool. We'll see you guys in a few hours when we join back in. All right, boom.